Well, the way this has worked out in history usually is the debt gets higher and higher until the country has a serious debt problem. And then they come in with exchange controls. They say, okay, if you want to travel, you can only take $50 or whatever it is. And this exchange controls get very tight, get very serious. And you and I cannot go to Toronto even because that's considered dangerous. And the exchange controls get tighter and tighter, which means debt gets higher and higher for everybody. And then you have a debt crisis and a currency crisis, and it's not fun.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The past few years have been full of surprises, often going the exact opposite way that Wall Street expected at the start of each year. Well, as we prepare to enter 2025, and with it, a new U.S. presidential administration, I might add, it helps to tap the expertise of those investors who have been around the longest and been the most successful. High on that list is Jim Rogers, legendary international investor, financial commentator, and author of several best-selling books on wealth building. Jim, thanks so much for coming on the program today, all the way from Singapore.
I am delighted to be here, Adam, but I hasten to correct you. I have made many mistakes in my life.
I'm sure you have, but I sense, Jim, from our previous conversations, as well as from your general demeanor, you have come out on the good end of more than your mistakes.
Well, yes, I have occasionally gotten it right, yes. But Adam, you want to hear about my first wife? What a horrible mistake that was.
But maybe not a bad analogy. You know, we learn, we improve, and then we get on to better heights. All right, well, look, lots going on here. I've got a lot of questions prepared for you here, Jim. If we can, let's kick it off with the intentionally general question I like to ask you at the start of these discussions. What's your current assessment of the global economy and financial markets?
Well, Adam, I'm going to use the U.S. since it's the largest, but and it affects everything. The U.S. has had the longest period in its history without a big stock market problem, big problem. We've never had, 15 years or whatever it is now. We've never had such a long period without big problems. So history would indicate that we're getting closer to a big problem. Now, Washington says, don't worry, we've solved it. We'll never have problems again. Well, if you believe them, first of all, if you believe them, you're in serious trouble. And second of all, if you believe them, there are no problems coming. But no, we are late. I'm not selling short yet, but I do see problems developing. We have lots of new investors coming in who are very excited and think this is a wonderful, easy way to make money. So I can see the problems developing. Inflation is starting to come back in many parts of the world, but I'm not selling short yet. But I have certainly reduced my longs by a gigantic amount.
Okay, so this week we're talking, Jim. The world has somewhat changed recently in the sense that the Federal Reserve has pivoted now, so it is now officially cutting interest rates. The ECB preceded the Fed, so the ECB has already been busy cutting rates. And then China just announced big monetary and fiscal stimulus. So we now have basically the world's biggest economies. They've returned to an easing cycle. Some people out there cheer that and say, hey, fantastic, happy days are here again. This is going to be what it was like, pre-COVID, between, the recovery from the GFC to 2021, where we had all this tailwind at our back from the central banks. I don't detect a similar sanguine tone in your voice about this.
Well, maybe it's just because I've been around a long time, but I know that when everybody's happy, somebody should think about going home. Somebody should think about leaving the party. And as I look around the world, even the Chinese market now is booming. Everybody, Japan, the Japanese market was down for 35 years. You weren't even around when the Japanese market made its last low. So everybody is having a very, very good time now. As I said, even China was in the dumps for a long time, but now it's booming. So Who's left? Who's left? I mean, I own Uzbekistan, but that's not enough to save the world. I assure you. I'm looking, but I don't see anybody who's going to save us.
Okay, well, Jim, you're out there in Asia, so you know, one could say you've got sort of a front row seat to what's going on in China, and maybe a close seat as well to what's going on in Japan. Again, from the tone of your voice, it sounds like it doesn't sound like you think that whatever life those markets are showing right now is going to continue for very long. Is that a true statement, or I don't want to mischaracterize?
Well, that's an accurate statement. I wish I'd said it myself. You're a smart guy.
No,
They don't need me.
Well, look,
No, I mean, Adam,
yeah.
Adam, just to repeat, I don't know any market in the world. I'm sure there's somebody, but any market in the world that's depressed, that's down in the dumps. Everybody is either wildly happy or getting happy. And that has usually been a sign that start worrying. So I've started worrying.
So you've started worrying. Okay, so it sounds like you're not joining this party. If I heard you correctly, you've reduced your longs. You haven't gone short yet, but you've been cutting back on your long positions.
That's exactly correct. Yes.
Okay. Let me just ask you one more question about China, and then we'll get into a few other things. But because it's early on in their stimulus programs, there is, I think, understandable, healthy debate going on about whether they are going to actually result in an economic recovery in China, or are these sort of the desperate measures of a desperate regime, and they might not get all that much for what they're doing right now to try to goose their markets in the short term?
Well, either one of those alternatives is much better than what was going on before.
Okay.
When everybody was collapsing. I mean, China got hit with two things. They got hit with the COVID virus in a big way, and they had one of the biggest property bubbles of all time. Mm-hmm. They tried to stop it for many times, but they were unsuccessful. But now either the government or the market or somebody has popped the bubble. And so China's got hit with two serious things. Beijing realized it. Beijing started pumping now to try to make things okay again. When governments try to make things okay, even if they fail, it's good for a while, because governments have more money than I do. And if they want to make things happy, it seems happy. And again, Adam, I don't know any country in the world that's not having a good time now.
Good time, yeah. Yeah, and just sort of reversion to the mean. When everybody's getting an above-average hand at the poker table, pretty soon somebody's going to start losing. And maybe I lied. Let me ask you another question about China and Japan. Again, given your proximity to those countries, there has been a narrative, I think, in the West for a while, amongst many, that over the past couple of decades, China a rising superpower, and some thought, hey, it may eclipse the U.S. at some point, right? It may become the dominant superpower over time. They also have, in addition to a lot of the economic progress that China's made over the past bunch of years, they do have some pretty sizable demographic challenges, and they have a much higher debt burden now than they did, say, coming out of the global financial crisis, which places limits on their future prosperity. Japan obviously has massive demographic problems. What do you see, not short term now, we're talking long term, next couple decades, what do you see as the prospects for those two countries relative to the big countries of the West, like the US?
Well, let's take Japan first, since you mentioned it last. I mean, sure. Japan has had a declining population since 2010. That's 15 years of decline. And I don't see anything that's going to turn it around, especially since they don't allow much immigration. Mm-hmm. They expanded immigration recently, a tiny bit. So I don't see anything that's going to save Japan. The debt goes up higher and higher every day, every week, and the population goes down. And unless something happens dramatically, the population is going to continue to decline. with the debt rising. Now, Adam, you can add, you can subtract, at least I can, I hope. So I know that is a serious problem. And I mean, they can have temporary, and they are having a temporary short-term solution. They spent a lot of money, gave incentives, but how does that turn into a great, prosperous, thriving nation over the long term? If you were a 10-year-old Japanese, you probably should move. You should think about immigrating somewhere, because I don't see, when you're 40 years old, I don't know what's going to be there. To China. But that does not mean the stock market cannot boom, and it has been, as you know, because the central government started putting in a lot of incentives. Now, I bought Japan great, but I sold it badly. I sold it much too soon. Who knew it was going to go as high as it went? I certainly didn't. To China, I own Chinese shares. I have not sold them, and China is now trying to make things okay. Any government has enough money and power to make things okay, at least for a while. But I mean, in 2007 and 8, the Chinese bailed us all out because they had a lot of money saved. But now even
and very low debt.
Yeah, yes, they had very low, but even now the Chinese even have a lot of debt now.
Yep.
So the world has changed. I guess North Korea doesn't have much debt, but they can't bail us out. I don't think so. So
not much electricity either, but yeah.
Well, yes. So maybe we should go into the electricity business in North Korea and thrive. I'm not, but do it if you're optimistic. It is changing that country, by the way. But back to China. China is booming right now. The government put in a lot of incentives to help the economy and the markets, and it's working. I mean, Adam, if you give me a few $1 trillion, you and I'll have a very good time. And that's what's happening in China. They're having a very good time because the government put together a few $1 trillion and it's working.
Okay. So the question there, obviously, which none of us know the answer to, is how long will that sugar rush last? To the spirit of my question, and I know I'm just asking you to guess here, but when you look out, Jim, a couple of decades, when you think of that 10-year-old Chinese kid, do you feel similarly about China the way you do to Japan? Or do you think China's going to have a very different future than Japan long term?
China is going to have a very different future from Japan. China is the only country in history that's been on top 3 or 4 times in its history. It's collapsed 3 or 4 times in history too, been a disaster. But for whatever reason, China turns around after a few decades or centuries on the bottom and rises to the top again. It seems to me that's what's happening again. But Adam, that does not mean there won't be problems. The United States was the most successful country in the 20th century, but we had unbelievable problems along the way: Civil War, depressions, bankruptcy, everything. But we became extremely successful. That's my view of China as we speak today.
Okay. All right. Well, let's talk about something you mentioned earlier, which is inflation. So you've said that it is beginning to turn up in numerous parts of the world again. Obviously, this stimulus and easing that I mentioned earlier, that's probably not going to help the situation, right? That's probably pro-inflation in a lot of these regions. What is your inflation outlook from here globally?
Well, I know that many central banks, including ours, Washington, has printed a lot of money in the past few years, a lot. They say they've slowed down, and they seem to have, but all that money is still out there, and the debt in the U.S. is staggering. I'm old. It's good to be old, Adam. My children, it's not a good time to be a young American, because the problems that my children are going to have with debt and problems like that are gigantic. I can remember 100 years, I wasn't there, but 100 years ago, Britain was the richest, most powerful country in the world. 50 years later, they were bankrupt. That's not a typo. 1976, The IMF had to fly into London to pay the bills. They literally went from number one to bankrupt. That has happened many times in history to countries. And I mean, I look at the numbers and I just cannot conceive that somebody doesn't understand the problem. But in Washington, they will tell you, don't worry, you don't understand. It's things are different. We have solved the problems. But Adam, I repeat, it's a good time to be an old American.
Right. Okay. Well, look, I want to get to when I follow kind of the dots that you lay out, Jim, it's pretty easy to get to the point of, okay, purchasing power of currencies, including the dollar, the world's reserve currency, are going to go down relative to real things. And so I do want to get in a moment kind of to commodities, which you're very well known as an expert on, but also precious metals and any other stores of value that you think might be worthy of investors considering to protect against that. But before we do, I asked you about inflation because I wanted to get your thoughts for a moment on bonds. Interest rates generally are a function of inflation expectations. We have had this 40-year bull market in bonds, and we're now at a point where it's interesting. I would say this is probably the topic of greatest differentiation of the experts that I interview. I'd say roughly half think that make the argument that interest rates are going lower from here and that bonds will do well, you know, in the next year or so. And then I have about half that say, no, inflation is stubborn, and in fact, it might be turning up, and they expect higher interest rates going forward or higher bond yields going forward, and that would be lower bond prices. So I'm curious, do you have an opinion on where bonds might be headed? Interest rates
Well,
and bonds?
I do not own bonds, but I am not short bonds either. So I guess that means I don't know,
Okay.
or I do know, you know, that it's not a time to be long or short, because I don't see anything that can make bonds go a lot higher. Not at the moment. Uh, Maybe there is something, I just don't know it. But I'm not short at bonds, as I say. Because I think certainly the central bank in the US is more confused than normal. They say that everything is okay. They've said that many times in my life, as you know. They say everything is okay and not to worry. Well, I know they don't know what they were doing, not that I do, but when they say don't worry, I have to scratch my head and start thinking.
Start thinking, okay, yeah, maybe I should worry a little bit. So if you are, if as you are, it sounds like you're somewhat concerned. You're playing things from what I'm detecting from your words and your tone, Jim. I'll say conservatively at this point in time. If you are worried about kind of the longer arc of this, which includes a reduction in the purchasing power of just fiat currencies in general going forward, are you still a commodity in favor of commodities at this time?
Well, first, I will say to you, I've said before, but I do own gold and silver.
Mm-hmm.
If I were buying one right now, I would buy silver. Silver is down a lot from its all-time high. Gold is near its all-time high.
Mm-hmm.
So I would buy silver if I were buying one today. But I certainly, I look at the commodity markets and I know that things are somewhat depressed, certainly supply demand. Oil has started rallying again recently, but oil was down 2 weeks ago, or a week, whenever it was. So I would rather be in commodities than in United States shares as we speak here in 2024.
Okay. All right. Well, that's definitely a statement. Okay. So let me ask you this, Jim. So you are an avid student of history. I know from our past discussions and from your books. We have a couple of large conflicts going around in the world right now. There's the war in Ukraine with Russia. There's the sadly escalating conflicts in the Middle East again right now. We have the tensions over China and Taiwan and U.S. interests. As you look at those conflicts with the arc of history in your mind, how worried are you? A lot, not much at all? Are those the things to be watching? Are there other geopolitical trends that you'd watch more?
Well, you are perceptive again. If you look back at history, when big wars break out, they usually start with small wars, somebody over there and nobody pays any attention.
Mhm.
And then there's another small war and then another one. The next thing you know, it's a big war. It's on the evening news and everybody knows there's a big problem. I sit here and look out the window and I say to myself, my gosh, this has happened before. You mentioned a few small wars that are going on, and there's some other potentially big wars. Taiwan, uh, by the way, I'm worried about Taiwan, very worried, but mainly because of the US. The US keeps hitting people in the face for some reason.
Hmm.
The Chinese are just sitting there waiting. I think in Beijing, they think, if we wait long enough, we don't have to worry anymore. They've been around a few thousand years.
Right.
But anyway, I am certainly worried. What worries me the most is it's happened before in history. You have various small wars that have turned into big wars. I don't see a big war anytime soon. I just worry of what's happening out there because it's happened before. Now, the last thing anybody wants is a big war. And if it happens, people always say, it'll be over by Christmas. Don't worry. We'll beat them. We'll show them. And at Christmas, the boys will be home and we'll all be celebrating. I've heard this movie before. I've seen this movie before, and it worries me. It's not happening yet. I'm not predicting it, but I'm just saying. I sit and look out the window. I've read about this story before. I hope it's not happening, but the picture I see out the window has happened before.
Okay. So one of the big developments of the past couple of years was when Russia invaded Ukraine. The US, really for the first time ever, weaponized its financial system against Russia. And whether or not people think that was the right or wrong thing to do, what it seemed to do was send a message to the rest of the world that the US had crossed a line or was willing to cross a line that countries didn't think it would have crossed. And therefore, a lot of countries that are, perhaps soft allies of the US said, wow, wait a minute. I might not be in the US's good graces someday, and I don't want this weaponized against me. And so you've seen some coalitions develop, around the world, trade alliances. There's been rumors of a BRICS currency. I don't necessarily want to ask you to opine on that unless you have a strong opinion. But the world apparently is becoming more multipolar now than it was pre-Ukraine war. Is that a trend that you indeed, are paying attention to? And do you think that that's a trend that will continue from here? Was that weaponization of the financial system kind of a Rubicon that the U.S. crossed that has kind of changed geopolitical relationships, for the foreseeable decades going forward?
Adam, that is extremely observant. Yes, the US for a time in history is driving people away from the US dollar. As you point out, many of our friends are saying, wait a minute, they could do that to us. They could do that to me if I'm not careful. And unfortunately, that is a fact. And Washington doesn't seem to know or care what they're doing. I own a lot of US dollars right now. My plan is that when there's turmoil again, the dollar will go up as people look for a safe haven. I hope I'm smart enough to sell them if it happens. I don't know. Your next question should be, well, where will you put the money? And I don't have an answer. In theory, it should be the Chinese currency, but the Chinese currency is a blocked currency. So that's absurd. It cannot be the international currency if it's not convertible. So I don't know. Yes, I own some gold. Yes, I own some silver. Yes, I own some commodities. But where would you put your money if you could not put it in the US dollar? And as I look around, I do not see the new competing currency. If you know what it is, Adam, please do not announce it on this show. Send me a private email.
Well, I'm actually gonna give you a conjecture what it is, and it's only because you've mentioned it, right? Which is, I think an answer to that question is gold. And the reason why I say that is because one of the biggest buyers of gold of late have been the central banks. So they are essentially buttressing their balance sheets with an increasing amount of gold going forward. So at least they have made a choice here.
Well, I have learned in my career that investment banks, I mean, central banks usually do not know what they're talking about or
Yep.
know what they're doing. But I mean, yes, I own gold. I have some right here in my pocket just in case. And yes, I am in the market to buy more silver. And if gold goes down, I will buy more gold. But I mean, if the whole world has to move from the US dollar to gold, oh my gosh, and there isn't the high, who knows how high gold would go at that point. I cannot count that high. So I don't know. Maybe that's it. Maybe that's it. And in times of huge crisis, the world always returns to gold, and we probably will again, but there's not enough gold to take care of the whole world unless the world gold goes to 30,000 or something.
Mm-hmm.
Which would be great. I would love that. I have some gold. You saw I have it in my pocket.
Yeah.
I wish you were worth 30,000.
Well, look, for those that would accuse me and you of talking our books, let me just ask the question because I'm sure it would come up in the comments if I didn't. Some would say, well, hey, that's why Bitcoin was invented, right? Which is, another sort of anti-fiat dilution asset class. Do you have thoughts one way or the other about Bitcoin and its role in a regular person's portfolio?
Well, I have never bought nor shorted Bitcoin, so I'm neutral in that respect, except that I don't expect Bitcoin to be the new currency. Uh, I I don't see most governments saying, oh, okay, if you want, this is the money, but if you want to use that money, you can use that money. I mean, Washington is not going to say, Adam, if you want to pay your taxes with Bitcoin, okay, send us the Bitcoin.
Mm-hmm.
That's not the way they think. They want monopoly, they want control, they want power. So one of the advantages of Bitcoin is no one can have a monopoly or power, I don't think. So I don't see Bitcoin coming to the rescue to replace the US dollar. Maybe it will. I've made many mistakes in my life, but no, it's not for me. It's a great trading vehicle. I know a lot of people have traded a lot and made a lot of money. Many cryptocurrencies have gone to zero and disappeared, as you know, but I'm not trading either one of them, any of them, because I'm not smart enough.
Okay. I've interviewed some former Federal Reserve senior executives. I'm thinking in particular of Thomas Honig, who sat on the FOMC for a number of years. And I've asked them about CBDCs, and the answers that I've gotten, and again, none of these people are obviously currently sitting at the Fed, but their answers kind of jive with the Fed's public answers, which is, it's some things we've got some people kind of looking at, but it's nothing that's, on the work list that we're trying to launch anytime soon. Now, I know a lot of people distrust that. I have no clue. My question to you, Jim, is if you have any strong thoughts one way or the other on the CBDCs. I guess the only maybe opinion of mine I'll submit is trying to be a student of monetary history, not one as accomplished as you. I do kind of think it is sort of like a central banker's fantasy, right? It's a currency that would give you total control, total visibility, give you a lot of other options, right? If you wanted to stimulate the economy, you could send it directly to people. You could put an expiration date on it, so the money would have to get spent, so you could just force money into the economy when you wanted to. So I'm curious, do you think we are eventually moving towards CBDCs at some point?
Well,
Or
the
digital
currency you just
currencies?
described The currency you just described has been tried before. It's always led to currency collapse, as you probably know, and they may try it. That's why it's been done before many times, because central banks or central authorities look for a solution when they have a problem, and they look for the easy way. And the easy way is always just print more money. And whether you call it printing money or not, you can disguise it. They often try to disguise it. But what you just suggested, and it may come, is not good for whichever currency is happening. That's the US dollar. That's the reason the US dollar will go the way of the many other currencies. The British pound, for instance. 100 years ago, the British pound was the single most important currency in the world. There was no number two. Well, 50 years later, it was bankrupt. So all of this has been done before. If you can read some history, you can see, yeah, they did that once before, twice before, 100 times before, and it never worked. I hope it works, Adam. That would be wonderful if they could save us all. They never have.
Well, let me ask you this, Jim. So during COVID, which was, a massive global crisis that nobody saw coming, we did something we really hadn't done before in the central planning playbook, where it wasn't just the Fed stepping in to rescue the system. We on the fiscal side, we sent checks directly to households, right? Using my term of, was that, a Rubicon being crossed? Was that another Rubicon we crossed? Now, in other words, do you think that will be the playbook going forward for kind of any garden variety financial crisis we have? It's now going to include both monetary and fiscal intervention.
Of course, they're going to do whatever they have to save themselves. Adam, they don't care about you and me. They're trying to save their own jobs. And they're going to look for the easy way to save their own jobs. And you said crossing the Rubicon, of course they did. But all of these things, looking back, one step leads to the next step. And then the next thing you know, they say, we can do anything. And so they do anything. And we all suffer. I mean, history's full of stories like this.
Like this.
You're not the first person to notice this.
No. Well, that's why I value your opinions, because you have so many examples in your mind there. So let me ask you this, because not only my opinion, you don't have to share it, but not only did the central planners decide this was in their best interests, but now that the public has experienced it, I find it hard that the next time that we go into some sort of rocky national period financially, that the public is going to demand it, right? They're going to say, hey, you did it last time, do it again now. In fact, give me more, because I'm hurting more this time. So it's this pernicious process where not only the central bankers doing it to save their necks, like you said, and they're kind of mortgaging our future to do it, but the populace is cheering them along the way because they're so short-sighted.
Hooray. Yes, that's what always happens. Human beings are still the same. We've always been human beings. We always want the easy way. We always want the free lunch. Don't worry, I want the free lunch too. We all do. But the free lunch has consequences. It always has. But that doesn't mean they won't try it. People will say, oh, we did it before, remember? Now we can just do a little more and everything will be okay. Adam, I mean, I back to the US, because I'm a US citizen, I am stunned at the level of the debt now. I can count, I can see. There's no way that my children won't have huge problems in their lifetimes. And maybe in my lifetime, perhaps. Hope I live long enough to see many big problems. But no, Adam, I know you can add and subtract. I know you can count. I wish they could in Washington.
And you know what, I'm opining here, but I think in Washington, the challenge is so many people who get elected into office, there is no requirement for economic or fiscal literacy. So their level of economic and fiscal literacy is low. And to the extent they have any, there's a willful blindness that then goes on once you're there, because you want to be doing all sorts of things that you want to fund today to advance your interests, and however it gets paid for, that's somebody else's problem in the future, right?
That's how you get elected.
Exactly.
You just say, don't worry, it's going to be okay.
Okay. It's so funny. Again, I know you're a big student of economic history, and one of the elements of economics that really fascinates me is behavioral economics, how people make decisions around money, because you would think we make exceptionally rational decisions because it's all quantifiable. We make incredibly irrational decisions because we're human animals. And as you were talking earlier, it made me remember the saying I'd heard, which is the human species has space-age technology, which it is managing by using medieval institutions, and yet our individual wiring is still prehistoric, right? So we still make all the same mistakes that we made, eons through the eons. We just do it with much more dangerous tools this time around.
Well, now we have television. These guys can go on TV and say, don't worry. We know what we're doing. We have the situation under control. The Treasury Secretary in the US right now says, don't worry, we know what we're doing. We've solved the problem. Hooray, hooray. Magic. All you have to do is go to an Ivy League school and get an Ivy League degree, and you know what you're doing.
Well, Jim, you've seen a lot of central bank administrations come and go. You've seen a lot of US Treasury secretaries come and go. What is their batting average on their predictions?
Well, it's not just
abysmal,
US,
right?
It's not just US central bankers. I've seen central bankers everywhere in many places. And the number of, there was a guy in India a few years ago who was very smart. He's gone, needless to say. You think back, and the US has had in the last 100 years or so a couple of smart central bankers. But you heard a couple, in 100 years, two smart guys is not a good record. So I don't see anybody in our lifetimes who will get it solved. The problem, Adam, is if somebody runs and says, we got to solve this problem, and this is what we have to do, somebody will say, oh my gosh, that's correct. And he or she will be elected. But after the pain comes at them, this is going to cause a lot of pain to solve this gigantic problem. Mm-hmm. Everybody's going to say, well, wait a minute, we didn't know it would be this bad.
Right. And nobody could have seen this coming. Yeah.
Yeah, they'll throw her out. They'll start with somebody else. They'll come for somebody riding in on a white horse who says, I'll save you. And the guy on the white horse or the woman on the white horse will ruin us all.
All right. Well,
Adam, I hasten to tell you, this is not going to happen this year. We're not going to be ruined this year. We have some time before we're all ruined.
All right, good. Thank you. Because I was literally just saying, I was trying to think of a way to maybe help take people's head out of the oven. So you just did it for me. But let me walk through this progression, Jim. So you've said a couple of times, huge problems, gigantic problems, either in your daughter's lifetimes, and your daughters are at least teenagers. If not teenagers now.
Well, one's a freshman in college, a senior in college now.
Okay. So they're not babies. Their adult lifetime is coming up pretty fast. So when you talk about huge problems or gigantic problems that generation is going to have to face, or maybe still in your lifetime, like you said, could happen sooner, what are some of the biggest things that you are concerned about when you say big problem? Is it a currency collapse? Is it a meltdown of the financial system? Like what are some of the knock-on effects of this big debt? I mean, at the end of the day, it's debt for you, I imagine. So what are the biggest repercussions that you're concerned about?
Well, the way this has worked out in history usually is the debt gets higher and higher until the country has a serious debt problem. And then they come in with exchange controls. They say, okay, if you want to travel, you can only take $50 or whatever it is. And this exchange controls get very tight, get very serious. And you and I cannot go to Toronto even, because that's considered dangerous. And the exchange controls get tighter and tighter, which means debt gets higher and higher for everybody. And then you have a debt crisis and a currency crisis. And it's not fun. I mean, read back over past countries where this has happened. I mean, this happened to Britain in the 60s and 70s. You and I were both around then, and it was a mess. It was a gigantic mess. Britain, which had been the most powerful country in the world 100 years before, was bankrupt. But that's happened to many places. Spain, France, look at around the world, look at history. China has had collapses a few times. I mean, China's the only country I know of that's been on top 3 or 4 times, but that means they collapsed, totally collapsed 3 or 4 times. It was a nightmare for 100 years, 200, whatever, for decades, centuries. But then they turned around. But that did not mean, Adam, that they didn't have a gigantic collapse, civil war, bankruptcy, et cetera, in the meantime. So, I mean, again, it's a good time to be an old American.
All right. So let me ask you this. So people who are watching who are concerned about this, a couple of things. One, you're not calling for this all to go down tomorrow, right? So nobody should.
I own the dollar. I own a lot of dollars.
Okay. So nobody should, just liquidate, get out of everything tomorrow. This is going to be a progression. So my question for you, Jim, is what counsel would you have for somebody who's listening who's concerned about this? And I'll seed your answer by saying the vibe I'm getting from you is just to be more cautious than speculative at this point in time, and maybe work on hedging, reducing your risk. If you're in the market, be diversified. Again, relatively defensive, relatively conservative. And I assume at some point your strategy is by the time this all starts really building momentum and going down, you're probably going to be in a very liquid position, I imagine, and that your strategy is to have a bunch of dry powder to deploy once the dust settles. Have I accurately captured kind of your outlook, or you pursuing a different course?
Perfect description. I hope I'm that smart. I hope I do it. I can sit here and tell you exactly what's going to happen. Does that mean I'm going to get it right? Of course not. Gosh, I've made many mistakes. We all have, no matter how prescient we are. Many people have lost everything, even though they were geniuses. It's not the first time. I just once upon a time, a few decades ago, I made a huge play in the market, and I was so right. And then I did exactly the right thing, but a few months later, I'd lost everything. I was the smartest kid on the block, lost everything. I was so smart. I thought. So it doesn't matter what I tell you, Adam. It's the execution, and at the time, who knows? Something always comes out of the blue that I hadn't expected, or that people don't expect. I wish it were easy. This is not an easy way to make a living.
Well, Jim, this is why you don't have to comment on this, but this is why so often on this program, I encourage people, unless they have a very successful track record, and to be honest, I'm going to call BS on anybody saying that they've got a better track record than Jim Rogers, and Jim Rogers thinks this is tough. Where I say, rather than go it alone, especially if you're not that experienced, find a good professional financial advisor who has the appreciation for the scope of history that you do and you've talked about here, understands these macro risks that we're talking about. Because Jim, I'll tell you, there's a lot of financial advisors out there that don't take into account anything that you've mentioned. They just grew up in the era of buy the dip and the market takes care of you and always be long, right? So I'm just going to reiterate my normal advice to people, which is, again, unless you think you're smarter than Jim Rogers, try to find a good professional who can guide you here. Yeah.
Well, just to be clear, we will all watch your show and figure out what to do.
Well, thank you. Yeah, but just to reiterate, I talk about the advisors not because necessarily they're going to have a perfect track record, but they are going to help you hopefully avoid some of the worst mistakes that an inexperienced investor will make, especially during high emotional times where your emotions are driving your investment decision making. Find somebody smart with a good process and the discipline of history. Hopefully that'll bring your batting average up a little bit. Let me ask you this, Jim. So you clearly have concerns about what your daughters and their generation are going to be dealing with, just as you are a concerned father and a concerned human. A lot of these viewers have children, maybe adult children, not that much older than your daughters, who share these similar issues. And I'm sure they'd be really interested in hearing your answer to this, which is, how are you planning on passing the torch to your daughters? Are you trying to download all of your investment experience to them and have them, basically be the Jim Rogers 2.0 in the future in terms of managing, their wealth? Are you recruiting outside, how are you helping set them up for success here in what appears to be very challenging times?
Well, the problem with people is you cannot teach them unless they want to learn.
Mm-hmm.
If my daughters come to me and say, oh my gosh, please tell us about investing, I'll do everything I can. They have not come to me yet saying that. They know there is a market, they know a few things, but they don't seem to be bursting with enthusiasm to know the difference in stocks and bonds, or
just to interject, Jim, as a father of two daughters of similar age, I have the same challenge.
Okay, well, so being a father is a difficult situation right there, starting there. But no, I have not done anything yet because I am waiting for them to ask me. Because of my experience, that people just don't learn unless they're wildly enthusiastic. So no, I hope, set up enough safeguards to make sure they cannot just fritter off the money away if I ever die, but who knows? And Adam, life is full of examples of people who, I remember a lady told me once that when her parents died, the lawyers took her aside and said, oh, this is how much money you have. And the woman said, oh my gosh, that's a lot of money. 2 months later, she'd spent most of it, because she just didn't understand. I wish human beings were that simple.
Well, so I've talked to the surviving living author of the book, The Millionaire Next Door, which this is 2 PhDs that wrote the book. And basically it was a study of what do self-made millionaires have in common. And one of the things they have in common is that their wealth generally is gone by the end of their children's lifetimes. And it's not that the children are necessarily crazy spendthrifts, but it's that they didn't go through the same journey that the self-made millionaires did, and they just don't know how to preserve wealth the way that the people who made it knew how to do, and they didn't know how to build it the way that those who initially amassed it knew how to do. And so they just spend it, and by the time they're gone, it's gone.
Hooray. I mean, the world is, every nation I know, every society says rags to rags in 3 generations.
Yeah.
I mean, this is something that human beings have come up with, an observation that everybody knows. The first generation makes it, and by the 3rd generation, it's all gone. So I'm glad I'm not the 3rd generation. I hope I'm not the 3rd generation.
All right. Well, look, something tells me that if your daughters got even a small modicum of your neurons in their genetics, they'll wake up and they'll eventually come to Dad and start listening to you, Jim, on this.
Maybe they'll watch your show. Maybe Adam, maybe they'll watch your show.
That would be an honor if they do.
Right.
All right. Well, look, fantastic discussion as usual, Jim. I want to be sensitive to the fact that we're coming up on the hour here. Is there anything that I haven't asked you or that we haven't talked about yet that you think is worth imparting to this audience before we wrap things up?
Well, I just want to say, please, everybody, Be careful. Be worried. That's the answer. Be worried. And if you're worried, you'll figure it all out and you'll be very careful and you might survive. I just want everybody to be worried because if I'm half right, there are going to be many problems coming up in their lifetime. And this is not easy. You have to do a lot of research and homework and be aware. I wish I had an easy solution, Adam. Oh my gosh, wouldn't that be wonderful if I had an easy solution?
Well, Jim, if you find one, you are welcome back on this channel anytime to share it with us.
The solution then is to watch Adam.
Well, thank you. From your lips to God's ears, my friend. Well, Jim, look, I know you're not, doing much commercially these days, but if people want to follow you and your work in between now and your next appearance on this channel, where can they go?
Adam, I don't have anything to sell. I'm just a simple person trying to survive. So periodically I'm interviewed by smart people like you, but I don't have an answer to you. I've written some books, but they've been published a while back, so I don't have an answer.
Okay.
Do
How about
your
I give an
own.
answer, which is
My
that people
answer is everybody needs to do their own research, homework, awareness, because let's say that Joe told you what to do and you did it. But then if we was right, you wouldn't know what to do because you don't know why Joe told you to do it. And if you were wrong, you wouldn't know what to do because you don't know why Joe told you that in the first place. So my only answer is, please, this is not easy. Please learn what it's all about because there are going to be some bad times in the future. I don't know when or where, but please, please be prepared. Be worried and be prepared.
All right. And I fully endorse your call there for people to continue self-educating. It's basically the core mission of why I created Thoughtful Money in the first place, was to provide a platform that could help people do that. But I'm going to add one more bit of advice as a call to action to folks, which is to Google Jim Rogers. And that way you can find the other places he's been interviewed besides here. And if you haven't read his books, you can go read them. I guarantee you, folks, they're still incredibly relevant today. Jim, such a pleasure, my friend. Thank you so much for coming on. Best of luck to everything that you and your family are up to. And really look forward to having you back on the channel again soon.
Well, Adam, it's always fun. I always learn more talking to you than anything. So thank you very much.
All right. Well, now it's the time of the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by lead partners Mike Preston and John Lodra. Guys, great to see you. I'm sure you've got some great feedback on the interview we just did there with Jim. Also, as normal, I want to get into with what the markets have been up to over the past week. John, why don't we start with you this week?
Great, Adam. Thank you. Always great to be with you again. And we really always enjoy Jim. He's a guy that brings a lot of experience, and that experience allows him to take a step back and chuckle at some of the things we are dealing with here today, which are in many ways unprecedented. So we appreciate his levity, even though it's really about some serious stuff.
Yeah, gallows humor, maybe.
Yeah, exactly. You got to laugh it off in some ways. His talk today with you was big picture, and it's really important, we think, to have a big picture, even if our day-to-day jobs is about managing the near term, because we do always need to be mindful of the big picture as to what kind of backdrop we're working in, and but obviously working every day, hopefully to help our clients move forward. But his big takeaways there were here and now that. And we always think of Jim Rogers as in the same breath as commodities, and I'm glad that you touched upon that in depth with him today, because when you look at most traditional asset classes, stocks and bonds, they're a challenging place to be. And I thought it would be really interesting to share a chart that GMO recently put out in a great piece they just put out about kind of market cycles and tactical investing and things like that. And this chart basically shows, a traditional 60-40 stock bond mix. And, more than many people realize, there are lost decades that actually happen quite a bit more frequently than most people realize. And this goes back to, I think, 1900 here. And you can see there's many, and usually these lost decades happen in periods where at the start of that period, stocks most notably are very richly valued, overvalued, you could say. And we certainly have that box checked here today. We are at stock valuations that have rivaled only twice in history, right here at the tech bubble peak and right here at the precipice of the Great Depression. And we're in a situation here where the bond market we think is equally challenged, maybe not in the short term, but in the broader long term, because we've had a 40-year bull market in bonds that has run its course since 1980. This is a chart of 10-year Treasury yields, and most folks know that when yields drop, bonds tend to do well. Well, we're coming off 40 years here of a tailwind, and yeah, we've had a bounce here, but it was from very low levels. So we think at best bonds are going to be a kind of whippy trade going forward, especially with the kind of deficits that we're seeing and the almost certain return to stimulus and money printing that Jim and you talked about, which ultimately we think brings inflation back onto the scene. And it's in that breath that the commodities really become an important thing. And you look at commodities as a ratio of, for example, the S&P 500, we're at really near record lows. The last time we've seen levels here, we're at the peak of the tech bubble, and that ended up being a horrible time to be in stocks. It was actually a great time to be in commodities. So we agree that commodities, while from a short-term play, they've been challenged. We actually had our investment committee part 2 meeting today, and we did a deep dive into every sector of the commodity space, and the broad indices are starting to show some really encouraging technical developments, even if individual commodities have been quite whippy, cocoa and other individual commodities. But we do think that if we were to buy and hold for the next decade, we think commodities are probably going to be a great place to be, probably more so than just passively holding U.S. stocks and bonds for that matter. And I'll just use this opportunity to reflash up a chart that I shared in our video with you last week, Adam. And this is a study that was done by Bank of America that basically just did a kind of a take on what if we redefine the 60-40 to, instead of include treasuries, include commodities. And this shows over a long period of time commodities have done quite well, because there are periods like the 70s and in the last few years where things like bonds don't do well in keeping up that part of the equation. So big picture conversation there with Jim. We think it has a lot of relevance to look at that backdrop, and we do think there will be a pretty big play to have in commodities. We do have exposure in precious metals, and we have about 10% in gold mining stocks right now. We also have about 5% in a very diversified multi-commodity basket. We think it's a really good place to be for a tactical part of a portfolio right now.
All right, thanks. A couple of questions for you, John, then Mike, I'll come to you. One of them was, you just touched on it, how is New Harbor planning to play commodities for to take advantage of those themes you mentioned? Are you buying the commodities themselves? Are you buying producers? How are you generally getting your exposure to this?
Yep. It's really hard. So the broad commodity exposure we have is through an ETF that holds commodities futures contracts. Very hard to invest in commodities directly, and they can be very whippy. There's a lot of things with commodities futures that are tricky, with things like roll yield and things like that, issues of K1 forms. So we've specifically used an ETF that has a tactical approach to weighting across the whole commodity spectrum from a trend following standpoint, but they also use tools to optimize what's called roll yield, because when futures curves become either backwardated or contangoed, it can be a very, and I'm using very technical jargons here, but this is one way to kind of manage that. Plus, this ETF that we use doesn't issue a K1 form, which many commodity ETFs do. So you got to be very careful about that. We do have gold mining stocks right now, and we have owned them for quite some time, and they've done very well. We did a couple of weeks ago book some profits there and rebalance back to a target position. But we are starting to see some areas of the commodity resource stocks starting to perk up. Basic materials are looking decently better. Energy stocks are still laggards from a technical and relative straight basis, even though you might argue that they're undervalued relative to the broader market. So for the time being, in terms of broad commodity, we prefer to have exposure to the commodities themselves, not the stocks per se.
Okay. And then how about emerging markets? I know that Jim, plus some of the other folks I've interviewed very recently, like David Rosenberg, whose video would have come out just before this one, fairly optimistic about certain emerging markets. Same with Jan van Eck. Again, these are markets that generally have natural resource-based economies, so it's kind of a commodity play itself. Are you guys using emerging markets at all to kind of get exposure to this trend too?
Yep, we've had emerging market. We've been overweight emerging markets for some time. They are, broadly speaking, much better valuations than U.S. stocks. It's an ancillary benefit, we think, that they do have, broadly speaking, kind of higher exposure to resource type plays. So that's another tailwind we think will ultimately help those stocks. But right now we're broadly diversified in emerging markets. We don't have China exposure right now. It's been very whippy. China has shot up dramatically in recent the last week or so. It's pulled back pretty dramatically as well. So it's Jim spoke very, very pointedly to this. Any government can make anything happen for some time, but ultimately it can unwind itself with the weight of gravity. And we've preferred to stay, away from China for now, anyways.
All right. Last question, Mike, then I'm coming to you. John, can you just pull up the first chart that you had brought up there earlier?
Sure.
I think it makes a really good visualization of a point that we talk about from time to time, and I want to put that to a visual here, where you say we have these lost decades, and they're preceded usually by these really aggressive run-ups periods in stocks, and we talk about an asset price bubble or melt up, or you could even just say really aggressive bull run, where valuations, where prices get ahead of true valuations. We oftentimes call that a pulling tomorrow's pricing into today. And I think this chart does a really good job of showing that, where, as we have these aggressive run-ups in stocks, we've basically stolen the appreciation from the market for the following decade-ish, right? And so you've got to ask yourself, if you have a real bullish bias to where the market's headed over the next couple of years, you have to ask yourself, okay, well, what's different about this time versus all these previous other cycles?
Exactly right. And, it doesn't mean the advance can't go further. All bubbles go farther than they're supposed to, or many people think they can. But it's exactly that. These typically resolve themselves in the form of giving much, if not all, of that advance back. And, to point to the last decade plus of policies, it was very precisely the intent of QE and whatnot to accelerate that kind of asset price appreciation to hopefully give a kind of a wealth effect. And so a lot of the future has been stolen by front loading returns fueled by government policies, and we think that will ultimately play out kind of like what we see in this chart that we just showed up there. That will likely be probably a lost decade for most passive investors.
Okay, Mike, look, I'll let you say anything you want to quickly about the Rogers interview, and then I want to get your thoughts on a kind of a breaking development that's happening in the markets right now.
Sure, just a couple big picture themes that I enjoyed that I want to point out here. The humility in Jim Rogers is pretty impressive. He said several times, "I'm not smart enough to know the future." And he also said that many people lost everything, even though they were geniuses. So Jim Rogers, he started with George Soros back when he was in his 20s and 30s, I think. And
the quantum fund.
At the quantum fund, and he retired in his 30s and rode a motorcycle around the country. And so this guy is pretty brilliant.
Yeah. Hey, around the world, just FYI.
Oh, around the world.
Yeah.
So, but he keeps saying, I'm not smart enough. And so that should be lessons to all of us, that none of us are really that smart enough. We only do the best that we can based on data and based on our experience and based on risk control. I should add that as well. And as you and John were just talking about, the U.S. has just experienced a period of history longer than almost any other without a big problem. So he's starting to worry. Yet he also said he's not selling short yet. Well, that's probably because he's not smart enough and that he's humble. He talked about the dollar and the fact that the U.S. has been weaponizing the dollar, and the BRICS The BRICS countries have been meeting and trying to create an alternate system of payment, which they almost certainly will. But I don't think that's going to be an overnight negative for the dollar. And it seems like Jim Rogers agrees. The dollar is going to maybe face headwinds over the next 10 years, but it's not going to collapse anytime soon. A lot of our clients and people that we talk to that aren't yet clients are concerned about that. And we tell them it's going to be a process, not an overnight event. So the dollar should still stay strong for a while. Jim also talked about the hubris of central banks. They have decided that they can do anything. They've gotten away with just about everything and anything. And so that now they feel like they can do anything. And we should expect them to try anything and everything in the future, every time we have a hiccup. And as you pointed out, Adam, the public will absolutely demand it. And one thing I've learned in my career is that the public is going to line up and demand the bailouts, whether it's stimulus money or printing money, or even, I believe, central bank digital currency, which I think is coming in the next economic crisis. They will line up and ask for it. And that's going to be a loss of freedom and flexibility. Jim Rogers talked about exchange controls, that you won't be able to transfer money or travel with money or spend money in certain ways. And so that's a big problem, and that's likely happening in the future. So that was it. Those are the recaps of the big macro themes that I saw that you guys didn't talk about yet. Really enjoyed it.
Okay. Look, there's actually two things going on right now. I'll ask you one, then John, I'll come back to you for the last one. So as we're talking here right now, Mike, the yield on the 10-year is now 4.05. In fact, 4.051. So we can round it up to 4.1. So bond yields have moved pretty fast. I was interviewing Bill Fleckenstein earlier this week. He's not willing to say this is absolutely it, but he's been waiting years for the moment where, in his words, the bond market starts taking the printing press away from the Fed, where it starts, rebelling, meaning where the Fed comes in, tries to ease, tries to bring the short end of the curve down, and the response from the bond market is to bring the long end of the curve up because it's starting to lose confidence in the Fed. We've just seen the Fed pivot. It had its 50-point basis cut to the federal funds rate, short end of the curve. And here we've seen the long end continue to creep up here to the point where you don't have to agree with this, but Bill is saying, he says, I'm not sure we're going to see 3.6% on the 10-year for a long, long time from here. I know you guys have had a bit of a bond position. I'm curious, what are you taking away from this current action of rising yields?
And we're not really reading too much into it, Adam. To be honest, we think it's a technical bounce. If you take a look at what the 10-year was maybe a couple months ago, it hit a low of 3.6, I think. And that's after hitting a high of 5%. And we fully expected the 10-year to bounce towards 4% or even 4.2. And I think you're talking about bond vigilantes there. And I wish the bond vigilantes would have come in throughout all these years and push the prices of bonds down and yields up, but it really hasn't happened. And so that's the big shoe waiting to drop. A lot of people are thinking maybe the bond vigilantes will come in and the long yields will shoot up, but I just don't see that happening. There's a big debate about this, of course, and our call is that long yields will go down. In fact, that the 10-year should go below 3% in the next year or so, particularly if we're right about the stock market dropping. So I'm just looking at a yield curve here. It's true that the yields have gone up a little bit over the last month or so, but not a lot, and it's not something to worry about here at 4.05. Like I said, we see maybe we can go to 4.2. I should say that we've seen some technical reason to reduce a little bit our long bond position, and we have done that in recent days, just a little bit from around 10% to 7.5% in our main model. But it's not a big move, and we see yields going lower over the next year or two.
Okay, so let me ask this then: is there a yield at the 10-year that you might use as a signal to say, okay, we're going to buy some more then because it's getting to be a really good value?
Yeah, I mean, I think that if the yields took out their highs at 5% on the 10-year, we would strongly consider going to a higher position, maybe 15%. But a big message that I'd like to put out there is we never go all in. A lot of people want to just plunge all in and go 50% or 100% all in one thing. And it just doesn't make much sense. But Here we reduced from 10 to 7.5. We might go as high as 15 or even 20. That would be a big debate. That would be probably a maximum. And that would be on a shoot through 5% on the upside and maybe to 5.5 on the 10-year, which I don't see happening, by the way. But if it did, I think we'd probably increase a little bit into that move.
Okay, so it sounds like you guys aren't too worried right now about these current state of the yields. You expect this to be still a word from the Fed, relatively transitory, and that at some point rates are going to resume their march back down, or yields will resume their march back down.
They have to. I mean, I know the Fed only really controls short-term rates, but 34 trillion in debt, increasing by almost 3 trillion a year.
Yeah, by the way, it's over 35 trillion now.
Is it 30? It happens so fast, I lose track.
Yeah.
Increasing by almost 3 trillion. That's without a recession. We haven't had a real recession since 2008, and even that one was rescued. The COVID recession was such a blip. I don't even think it was a recession. So if we have a recession, that debt's going to shoot up even more. So we're in a very dangerous game here, and I would suspect that central banks will play other games like yield curve control, that type of thing. And it's a big question: who's going to win, the bond vigilantes or the Fed? And I think central banks, at least in the short term, win. We're not talking about buying 30-year bonds and holding them for 30 years. We're talking about buying 20 or 30-year bonds and selling them sometime in the next 2 years.
Yeah. Okay.
As a trade.
All right. John, coming to you for the last question here of the day. So it seems as if Google is now in the crosshairs of the antitrust regulators, and they're now recommending that Google actually be broken up. This is going to sound a little contradictory coming from somebody who runs his business on YouTube, a platform that's owned by Google. I've been talking forever about how, asking the question, how is Google not a monopoly, in several really important areas, search, online video, online advertising. And Google isn't the only big tech company that we can make similar claims about. So 2 questions for you. 1, how important is this development if indeed they proceed with it? And 2, do you think this stays with Google, or is this the start of a trend?
Great question, Adam. I do want to just add on to the little bit onto the bond discussion. Mike made the point, and I just want to emphasize it. We only had about a 10% allocation to long-term treasury bonds. We're now down to 7.5. That in and of itself speaks to our view on the bonds. I mean, Mike gave the short version. It's probably the most talked about topic we have in our investment committee meeting, bonds and interest rates. And the fact that we're so underweight, even a normal weight, speaks to, we haven't ruled out the possibility of yields going higher, because frankly, with the fiscal deficits that both of our running candidates have, and the likelihood that the Fed and Treasury can print as much money as they need to fund deficits, right? The question is what happens if that's the scenario, and bonds could probably get wrecked in that scenario, and that's why we have things like commodities and precious metals. So there is scenarios where bonds don't become balanced like we think they will likely, but that's why we have such a small position. But back to your question on Google, yeah, I think I personally, as a human, a citizen, and a father of 2 young men, I think it's great, because I feel like these large Goliath, by all senses of the word, monopolies have gone unchecked for too long. So I welcome it. Who knows how much teeth this will have and what it could be just a political show for all we know. But the ecosystem, this runs really deep. I mean, small startup companies start themselves not with the idea of becoming big themselves, but a lot of them start to, okay, I'm going to start this business, I'm going to sell to Google. That's like the mindset of entrepreneurs today, that they don't even think about their company becoming big enough to stand on its own, but hey, I'm just going to sell to Google, right? That really stifles in the long run, kind of the whole entrepreneurial system. And I got to imagine, for the same reason, if this does have some teeth with Google, that there's plenty of other companies, Amazon, Apple, you name it. And I, for one, would welcome that. We're staunchly capitalistic here, but geez, I mean, there's been distortions here that I think have gone unchecked for far too long.
All right. Well, and it's not just limited to tech. You know, I think it's pretty hard to find a sector that hasn't more or less metastasized into a cartel of a few big players who then, you know, work with the regulators to box everybody out. But we'll see. This very well could just be, you know, end of an election cycle, you know, kabuki theater to sway votes. And obviously, if a different administration is in power in November, you know, maybe this goes away. But it's interesting to see that it's progressed this far, and we'll keep an eye on it. I hate to start wrapping things up here, folks, but for timing wise, I got to do it. And I've got some important announcements to make to folks. First, let me just say that if you enjoyed having Jim on this program, and who doesn't enjoy hearing from the great Jim Rogers, please let him know and let him know that you'd like him to come back on the channel whenever he sees, you know, something that catches his attention on the macro stage. To do that, just hit the like button, then click the red subscribe button below, as well as that little bell icon right next to it. All right, the time-sensitive announcement is we are now less than 1 week away from Thoughtful Money's fall online conference. Phenomenal conference. If you haven't heard the lineup, it includes Lacey Hunt giving the keynote address, Stephanie Pomboy, Darius Dale, former FOMC official Thomas Honig being interviewed by Danielle DiMartino Booth. We've got Brent Johnson of the Dollar Milkshake Theory. We've got Stephen Bavaria talking about the income factory and how to invest for income. We've got Mike Leibowitz talking about bonds. We've got Rick Rule talking about natural resource investing. We've got Lynn Alden talking about how to basically protect your wealth against the devaluation of purchasing power of the currency. There's probably one or two others that I'm forgetting about. I'm just rattling it off the top of my head, but you can see we've got a phenomenal, Michael Pinto is in the mix as well. So we've got a phenomenal lineup, also including all day live questions that you can ask our financial advisors like John and Mike there, as well as Lance Roberts and Jonathan Wellham from up in Canada. So it is now happening, and it's now just days away. So if you haven't bought your ticket yet, run, do not walk to thoughtfulmoney.com/conference. Buy your ticket, lock it in. Don't worry if you can't watch live the day of the event, which is Saturday, October 19th. If you buy a ticket, whether you'll watch all of it, part of it, or whatever on the actual day of, replay videos of the entire event, all the presentations, all the live Q&A will be sent to everybody within 24 hours or less of the end of the conference. And just a reminder, if you are a premium subscriber to our Substack or rush to become one right now before you buy your ticket, you'll get an additional $50 off of the ticket price. All right, and then just for folks that haven't heard me go through this drill before, for all of the things that worry Jim and for the issues that John and Mike and I have talked about here, if you are looking for help in figuring out how to position your portfolio for these potential developments, highly recommend that most folks watching here work under the guidance of a good professional financial advisor, and one that takes into account all these macro issues. A lot of them do not, so you want to make sure you find a good one. If you've got a good one, great, stick with them. But if you don't, or you'd like a second opinion from one who does meet those criteria, perhaps even John and Mike and the team there at New Harbor, then consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple seconds. These consultations are totally free. There's no commitment to work with these firms. It's just a free public service that they generously offer to help as many people as possible, position as prudently as possible for what may lie ahead. John and Mike, gentlemen, thank you so much for being here for another week. Really looking forward to seeing you guys next week at the conference. John, I'll let you have the last word here.
Adam, thanks again. We really look forward to the conference. We work hard to make sure we take in lots of perspectives, and that's one of the very best ways we found to be glued to our screen for your conference, and it's our privilege to be able to answer questions live to folks that are so inclined to ask them.
Thanks. Yeah, it is basically like a 9-hour fire hose of macro insights from all these great experts. All right, well, look, John and Mike, can't thank you guys enough. Everybody else, thanks so much for watching.
Thank you, Adam. See you soon.